U.S. economic data is getting worse and worse. The data we discuss in this video suggest that the economy is literally crashing. Will this be good or bad for stocks in the short term if the Fed responds with interest rate hikes or cuts? We will take a look at the current situation over Easter holidays. Don't be surprised if, due to the omission of seasonal adjustments, the numbers experience a significant increase. This is precisely what occurred, and the figures jumped from 198,000 to 246,000, and the week before that, from 191,000 to 247,000. We recall the numerous Federal Reserve speakers who emphasized the strength of the labor market, suggesting there is no room for interest rate cuts. However, seasonal adjustments in major labor market data often don't make sense. When an unemployed person submits a claim for unemployment benefits, we have one claim. When another person submits a claim, we have two. The question arises, why can't we simply count these claims without manipulating them through seasonal adjustments? Why must we distort the entire statistic, rendering it senseless, yet still continue the practice? Graphically, we can observe the initial claims for unemployment benefits before and after the seasonal adjustments. It is quite astonishing that when watching basketball, we can discern each player's muscle movements down to the second. Yet, when it comes to central issues such as labor market statistics, we allow for practices that would be considered unlawful in Europe. Zero Hedge has reported multiple times on the contradictions in the data, revealing the continuing claims that, for the first time since December 2021, exceed 1.8 million. This leaves the labor market situation somewhat unclear. One thing is clear, the situation is not as favorable as the statistics have portrayed so far. This is further highlighted by the job cuts, which have reached their highest rate since Q1 2020. When asked why people were being laid off, most companies cited the macroeconomic environment and the necessity to reduce costs. This particular issue could take center stage in the near future. An increasing number of companies are attempting to streamline their operations as much as possible, anticipating that difficult times lie ahead. It is entirely conceivable that the Federal Reserve may be compelled to alter its approach in the not-so-distant future. Initially, this could involve halting further interest rate increases. On the other hand, immediate interest rate reductions appear to be somewhat far-fetched. It is quite likely that interest rates may experience a decline in the long term. However, this could have negative consequences, as businesses might become increasingly cautious, invest less, leading to unemployment, and consequently, a decrease in consumer spending. As a result, companies may see a reduction in sales and overall revenue. This pattern seems to be particularly evident among small businesses, which are more closely connected to the foundations of the economy. Such companies tend to feel the impact of economic changes much more rapidly than larger, globally operating corporations. Notably, the current rate of layoffs among small businesses surpasses that of the COVID-19 crisis, which is a telling sign. The inversion of interest rate curves is at a level not witnessed since the 1980s. These curves have foreshadowed what we are presently experiencing. When interest rate curves exhibit significant inversion, there is a lagging correlation with jobless claims. As bond markets, with their anticipatory power, are able to detect what lies ahead, unemployment rates tend to increase, and the real economy follows suit with some delay. It is important to note that stock markets do not necessarily have a strong correlation with the real economy. After the COVID-19 crash, new all-time highs in stock markets would not have been achieved if the real economy was the sole driving force. Despite the economic lockdown, stock markets reached new all-time highs, propelled by an abundance of liquidity. However, this liquidity is currently being stifled by interest rate hikes, which may create further uncertainty in the market and have wide-ranging implications for businesses, investors, and consumers alike. We do not yet have official figures on the state of bank lending. However, the analysis firm Apollo has examined 71 banks in the Dallas region and found that lending standards have tightened considerably. Banks are granting significantly fewer loans than before, which has psychological consequences. When banks provide fewer loans, businesses and individuals have less access to credit, which in turn leads to reduced investment and consumption. This trend clearly points towards a recession. We are also seeing money being withdrawn from major banks. Initially, only regional banks were affected, and as funds were withdrawn, these banks became more stringent in their lending practices. This leads to a dollar shortage, forcing them to sell assets and resulting in increased volatility. This volatility suggests that the Federal Reserve may eventually change its course, and the higher for longer approach may not come to pass. The last interest rate decision was a close call, with officials deliberating for a long time on whether or not to raise interest rates in light of the wave of bank failures. Now, the ironic twist to the story: American customers who have money in banks are withdrawing it and depositing it into money market funds, which now have a total value of over $5 trillion. These funds invest half of their money with the Federal Reserve through reverse repo facilities and receive a generous interest rate of 4.8%. The Federal Reserve has to pay these interest rates, resulting in an estimated loss of around $300 billion this year. Interest rates are high, and debt is rising at an ever-accelerating pace. It took 224 years to accumulate the first $10 trillion in debt. In the last 20 years alone, an additional $15 trillion has been added. It is likely that another $20 trillion will be added within the next 10 years. By 2030, the annual interest payments will amount to roughly $1 trillion. This trajectory is unsustainable. Such an exponential function cannot persist indefinitely. Something must give, such as debt cancellation or other measures. In conclusion, the current economic landscape is showing signs of strain, with tightening lending standards, increasing debt, and the potential for a recession on the horizon. As businesses and individuals face reduced access to credit, investment and consumption may decline, further impacting the economy. The Federal Reserve may have to reconsider its approach to interest rates amidst the growing volatility in the financial markets. It is crucial for governments, financial institutions, and individuals to be prepared for the challenges that lie ahead and to explore potential solutions for the unsustainable debt trajectory. As we navigate through these uncertain times, staying informed and vigilant is more important than ever.